We've been asking the wrong question about hydrogen, not does it work? We covered that in episode 1, not why do some projects succeed. We covered that in episode 2. The real question, the one nobody in this industry wants to answer clearly, is this: where does it actually work? Because the answer is far more specific than most people think, and far more limited. And if you're building a project, investing in a company, or advising a client in this space, getting this wrong doesn't just cost you time, it costs you everything. Here's what the research shows. When you strip away the announcements, the roadmaps, the government strategies, and the press releases, when you look only at the projects that have actually reached financial close, broken ground, and started producing, a pattern emerges. It's not random, it's not luck, and it's not primarily about technology. The projects that work are concentrated in a very specific set of industries, and those industries share something in common that has nothing to do with how advanced their technology is, how large their ambitions are, or how much government support they've received. They share a system where hydrogen demand already existed before anyone proposed making it green. A system where the buyer was already there, already creditworthy, already consuming hydrogen as a daily operational input. A system where the electrolyzer didn't have to create a market, it just had to be cost competitive enough to plug into one. That's the filter. And once you understand it, you can look at any hydrogen project in any industry, in any country, and tell very quickly whether it has a realistic path to financial close, or whether it's still waiting for a system that hasn't arrived yet. Before we get to the industries, there's one principle that governs everything else. There is no merchant market for hydrogen. Let that sit for a moment. In oil, gas, electricity, even solar, there are commodity markets. You can build a project and sell your output into a market that already exists. The price fluctuates, but the buyer is there. Hydrogen doesn't have that. There is no hydrogen spot market. There is no hydrogen trading exchange. There is no mechanism by which a green hydrogen producer can build a plant, turn it on, and start selling into a pool of buyers competing to purchase what they produce. Every single kilogram of hydrogen that gets financed and built is tied to a specific, named, contractual buyer before the project is funded. This is not a temporary problem that will be solved when the market matures. It is a structural feature of how hydrogen works as a commodity. It is dangerous to store and transport at scale, it requires dedicated infrastructure, and it is used as an input to specific industrial processes rather than as a general-purpose energy source. What this means in practice is brutal in its simplicity. If you don't have a signed offtake agreement with a creditworthy buyer before you approach a bank, you don't have a project. You have a presentation. And no company in this industry has demonstrated this principle more clearly or more expensively than Plug Power. Plug Power was founded in 1997, and for the first 2 decades of its existence, it built something that genuinely worked. The product was hydrogen fuel cells that replaced lead-acid batteries in electric forklifts. The value proposition was concrete and operational. Not a sustainability story, but an efficiency story. Hydrogen refueled a forklift in under 2 minutes. Lead-acid batteries took 15 to 30 minutes to change. They required dedicated storage rooms. They lost power as they discharged. For the world's largest logistics operators, this was a real problem with a real solution. And real problems with real solutions get signed. Walmart deployed Plug Power's systems from 2012 onwards, eventually running more than 10,000 fuel cell units across its US distribution and fulfillment network. Amazon invested $70 million in Plug Power in 2017 and deployed the technology across 11 fulfillment centers. Home Depot followed. By the mid-2010s, Plug Power had deployed over 20,000 fuel cell units and built more than 60 fueling infrastructures across North America. Run the framework against this. Power. Hydrogen delivered to on-site storage dispensed as needed. Straightforward and operational. Offtake. Amazon, Walmart, Home Depot. Some of the most creditworthy corporate buyers on the planet, with contractual recurring demand. Utilization. Forklifts run continuously across warehouse shifts. The utilization profile was exactly what hydrogen infrastructure requires. Financing. With those anchor customers, the revenue model was visible and bankable. The company went public. All 4 variables aligned. This is the captive demand model at its cleanest. The system was already built. The forklift market existed, the buyers were already there, the infrastructure was co-located with the demand. Plug Power found a system that worked and plugged into it. The forklift business was real, it worked, and it was genuinely the foundation of a viable company. Then came 2021. In January 2021, Plug Power's stock hit $73 per share. The company had a market capitalization of over $30 billion. For context, the company had never posted a full year of operating profit in its 24-year history. What changed was not the fundamentals. What changed was the narrative. The hydrogen boom of 2020 and 2021, driven by pandemic-era stimulus, the Inflation Reduction Act, and a wave of net zero corporate commitments, created an environment where hydrogen companies were valued not on what they had built, but on what they might become. Plug Power leaned in. The company announced plans to become a vertically integrated green hydrogen producer and supplier. Not just a fuel cell company serving warehouse logistics, but a full-stack energy business producing green hydrogen at scale, distributing it through its own logistics network, supplying it to third-party industrial customers, and exporting it internationally. $3 billion in revenue by 2025, 1 gigawatt of electrolyzer capacity by 2028, production plants in New York and Texas, a joint venture with Renault in Europe, a $1.6 billion partnership with SK Group in Asia. Now run the framework against this stage. Power. The new production facilities required dedicated renewable power at scale. Long-term power contracts were not fully in place before construction began. The power model was partially hope-based, dependent on future agreements and grid access that had not been locked in. Offtake. The industrial supply business required finding new customers, third-party hydrogen buyers outside the forklift ecosystem. These were not Amazon and Walmart. They were speculative industrial off-takers, early-stage commitments, forward-looking contracts that had not been stress-tested against real market conditions. Utilization. The new plants were designed for utilization rates that depended on the speculative off-take being realized. When the off-take was slower to materialize than projected, the plants sat partially idle. The capital cost per kilogram climbed. Financing. The financial model for the expansion only worked under optimistic assumptions. Strip out the subsidies, lower the utilization rate, raise the power cost, and the numbers collapsed. All four variables failed simultaneously. In November 2023, Plug Power disclosed substantial doubt about its ability to continue as a going concern. Revenue in 2024 declined 29% to $628.8 million. The net loss reached $2.1 billion, at a 54% increase from the year before. The operating margin stood at negative 321%. The New York production facility, the centerpiece of the expansion, stalled in construction. A $1.66 billion Department of Energy loan was won, then paused by the incoming administration. The Western New York project was officially abandoned in early 2026. The company hoped to recover $132 million by selling its land and power infrastructure to a data center developer. Against a county-assessed property value of $2 million. The stock, which peaked at $73, traded below $1 per share in May 2025. The accumulated deficit crossed $8 billion, and that wasn't a technology failure. It was a system failure. And here's the most important sentence Plug Power ever put in a regulatory filing. From their 2023 SEC disclosure, there is no assurance that our hydrogen production will scale at the rate we anticipate. That is a company acknowledging in a document filed with financial regulators that the system it assumed does not yet exist. But here is what most commentary on Plug Power misses entirely. Not everything failed. The forklift business, the original system, continued to function. Walmart still runs more than 10,000 Plug Power fuel cells. Amazon's facilities still operate on the technology. The captive demand model, where hydrogen is co-located with the user and the off-taker, is the same entity as the consumer, remained commercially sound throughout. What failed was everything built beyond the original system. The expansion into merchant production, the third-party industrial supply network, the global hydrogen empire. The system logic didn't fail Plug Power. Plug Power abandoned the system logic, and then had to find it again to survive. The pivot that began to stabilize the business in 2025 and 2026 was a return to captive co-located demand. Stationary power for data centers, The same structural model as the forklift business, applied to a new adjacent market. The $8 billion accumulated deficit is not the cost of hydrogen being unviable. It is the cost of confusing a system that works with proof that any system will work. So let's start with the industries that work. Not the industries that might work. Not the industries that are promising. Not the industries that have committed to transition by 2040. The ones where bankable projects exist right now. The first is petroleum refining. Refineries are the world's single largest current consumers of gray hydrogen. They use it every day, continuously, as a feedstock for the processes that clean and upgrade crude oil into fuels. Hydrocracking, hydrodesulfurization. These are not optional processes, Knight. They are what makes the fuel usable. This demand is not speculative, it is not forecast, it is operational. And here's the critical insight. A refinery that switches from gray hydrogen to green hydrogen doesn't change anything about its operations. Same pipelines, same process, same volumes, same schedule. The only thing that changes is where the hydrogen comes from. For a project developer, this is the closest thing to a guaranteed offtake agreement that exists in the entire hydrogen industry. The refinery was already buying hydrogen. It needs to keep buying hydrogen. The question is only whether green is cost competitive enough. And in jurisdictions with carbon pricing, regulatory mandates on clean fuel content, or strong corporate decarbonization targets, that question is increasingly answered in the affirmative. The system was already there, the project just had to plug into it. The second industry is ammonia and fertilizer production. Ammonia is produced from hydrogen and nitrogen. It is then used primarily to make the fertilizers that feed roughly half the global population. This is not a niche industry. This is one of the most critical industrial processes on the planet. And the ammonia industry is by far the world's largest single user of hydrogen, representing more than half of all global hydrogen consumption. Green ammonia means replacing the gray hydrogen feedstock inside the Haber-Bosch process with green hydrogen. The process is the same. The plant is the same. The product is the same. The customer base is the same. This is why the ammonia pathway is one of the most mature near-term opportunities in the space. Major fertilizer producers, companies with multi-decade operating histories, investment-grade credit ratings, and global customer bases are already moving. Real projects are at or approaching final investment decision. The NEOM project in Saudi Arabia, designed to produce 1.2 million tons of renewable ammonia per year, reached 80% construction completion in early 2025, with Air Products committed as the sole offtaker. CF Industries in Louisiana, Engie and Yara in Western Australia. These are not concept studies, these are construction sites. The offtake structure is what makes them bankable. The buyers were already there. The third industry is green steel. Steel is responsible for approximately 7 to 9% of global carbon dioxide emissions. The dominant production route, blast furnaces using coking coal, is fundamentally incompatible with decarbonization. You cannot electrify a blast furnace. The chemistry doesn't allow it. Green hydrogen enables a completely different production route called direct reduced iron, where hydrogen replaces coal as the reducing agent. The iron-making process is transformed. The carbon emissions collapse. For a long time, the bankability challenge in green steel was the offtake side. Unlike refining or ammonia, there was no pre-existing green steel market. You couldn't just swap sources. You had to find buyers willing to pay a premium for low-carbon steel in a market that had never priced carbon into steel before. That is changing. Corporate buyers, automotive manufacturers, appliance companies, construction firms are signing bilateral offtake agreements for near-zero emission steel. The First Movers Coalition is aggregating demand. The Steel Zero buyer platform is targeting up to 2 million tons of collective purchase commitments this decade, explicitly to make these projects financeable. The most advanced example is H2 Green Steel in Sweden, which raised $6.5 billion and is building the world's first large-scale green steel plant, powered by Europe's first gigascale electrolyzer. This is not a pilot. This is a commercial facility with secured offtake from named corporate buyers. The pattern is the same as refining and ammonia. The project didn't create demand. It found demand that was already committed and structured itself around it. Now let's talk about the industries that work, but only in the right system. This is where most of the confusion in the market lives. These are industries with real hydrogen demand and genuine long-term potential. But the projects that succeed are not randomly distributed across the sector. They succeed only when a very specific set of system conditions is met. The first is maritime shipping. Shipping is responsible for approximately 2.5% of global carbon dioxide emissions. It is one of the hardest sectors to decarbonize because the energy density requirements of long-distance ocean freight are beyond what batteries can deliver. Green hydrogen, in the form of green ammonia or green methanol used as marine fuels, is the primary candidate for a zero-emission shipping pathway. The demand signal is real and growing fast. As of late 2024, more than 250 methanol-fueled ships are on order globally. The first ammonia-fueled vessels are entering service. Major operators have made public commitments to scale up use of renewable hydrogen fuels significantly by the end of this decade. But here's the system question: where do those ships refuel? The answer is ports. And a port that can supply green ammonia or methanol as a marine fuel is an infrastructure asset with long-term contractual demand from multiple operators, multiple off-takers, high utilization, predictable volume. That is a bankable system structure. The projects that are moving and shipping hydrogen are not the ones trying to build a global supply chain from scratch. They are the ones built around specific ports, where the demand is co-located, the infrastructure is shared, and the offtake is locked from vessel operators who have already committed to the fuel transition. The system condition that makes this work is port concentration. When demand is geographically concentrated and operationally committed, the project becomes financeable. When it's dispersed and speculative, it doesn't. The second is mining. Mining companies operate at remote sites where diesel supply is expensive, logistically fragile, and increasingly subject to investor and regulatory pressure on emissions. Green hydrogen, used in fuel cells to power ultra-heavy mining vehicles, addresses all three problems simultaneously. The offtake structure in mining is the cleanest possible version of the hydrogen demand model. The mining company is both the hydrogen producer and the hydrogen consumer. There is no third-party buyer. There is no merchant market risk. The hydrogen is produced on-site and consumed on-site. This is the same structural logic as Plug Power's original forklift business. The system worked because the buyer and the user were the same entity. Mining replicates that logic at industrial scale. Real projects exist. Anglo American, Ballard, and ENGIE have partnered to retrofit ultra-heavy mining trucks with hydrogen fuel cells in South Africa. Fortescue in Australia has built its own green hydrogen facility for mining operations. The system condition that makes mining work is site specificity. It works at remote, long-life mines with high diesel costs and strong renewable resources nearby. It doesn't scale as a general industrial model, but within its system, it is one of the most risk-efficient hydrogen applications in existence. The third is industrial chemical clusters. High-grade industrial heat above 400 degrees Celsius cannot be electrified with current technology. Cement, glass, ceramics, certain chemical processes. These industries need heat, and the only zero-carbon option that can deliver it at the required temperature is hydrogen. The challenge is that heat demand is diffuse. There is no single large creditworthy buyer in most cases. The projects that work are the ones where a developer can aggregate demand across multiple users within a confined geography, an industrial park, a port-adjacent processing zone, a dedicated manufacturing cluster, and build shared hydrogen supply infrastructure that serves all of them. This is the cluster model. It works where the geography supports it. It doesn't work where demand is scattered. Now we get to the industries that don't work yet. This is important, not because these sectors will never use hydrogen, why, they will, but because the system conditions for bankable projects don't currently exist at scale. And calling them opportunities today, when the infrastructure, the offtake structure, and the market mechanisms aren't there, is how projects get stranded. Sustainable aviation fuel is the first. The logic is sound. Long-haul aviation cannot be electrified. Green hydrogen combined with captured CO2 can produce synthetic jet fuel, so-called e-fuels, that works in existing aircraft engines with existing airport infrastructure. The demand is real and growing under regulatory pressure, particularly in Europe, where SAF mandates are being phased in. The problem is cost. Green e-fuels currently cost 3 to 6 times the price of conventional jet fuel. Airlines cannot absorb that differential and remain competitive. The mandates are creating a floor of demand, but the volume is small relative to the total aviation fuel market, and the bankable offtake structures are still in early development. The projects that will reach FID first are those in the lowest renewable power cost geographies with the strongest regulatory requirements, and that convergence is still building. This is a 2027 to 2030 story at the earliest, for most markets. Hydrogen for road transport is the second. The technology works. Hydrogen trucks and buses are commercially available. Fleet operators have genuine interest. The system barrier is the chicken and egg problem of refueling infrastructure. A fleet operator will not commit to hydrogen vehicles without guaranteed refueling access. A refueling station developer will not invest without guaranteed fleet demand. Both sides are waiting for the other to move first. The only places this is breaking down are captive fleet configurations. A single logistics operator or port authority that controls enough vehicles to justify dedicated infrastructure. Beyond that, the broad public refueling corridor model remains subsidy-dependent and structurally difficult to bankroll through conventional project finance. Power generation and grid balancing is the third. The idea is technically valid. Produce hydrogen during periods of excess renewable generation, store it, burn it when demand peaks. Long-duration energy storage, seasonal balancing. The bankability problem is fundamental. Power generation revenue is variable. A hydrogen-to-power plant cannot be financed the same way a contracted industrial supply agreement can, because the electricity price it sells into fluctuates and cannot be locked in through a long-term contract with the same certainty as an industrial offtake agreement. The projects that exist in this space today are almost entirely dependent on government support or regulated revenue mechanisms. The system for independent bankable project finance in hydrogen power generation does not yet exist. Here is what the entire picture shows. Across every industry, Tier 1, Tier 2, Tier 3, the same variable separates the ones that work from the ones that don't. Not the technology, not the subsidy level, not the ambition. Whether the demand was already there before the project was conceived. In refining, the demand was there. In ammonia, the demand was there. In green steel, the buyers stepped forward before the plants were built. In the shipping projects that are moving, the vessel operators committed to the fuel before the port infrastructure was funded. In aviation, the demand is emerging but not yet contractable at scale. In road transport, the demand is conditional on infrastructure that doesn't exist. In power generation, the demand is real, but the revenue structure can't support project finance. And in Plug Power's expansion phase, the demand for a third-party industrial hydrogen supply network simply wasn't there. The company moved from a system that existed to a system it was trying to build. The capital followed the ambition, not the system. And $8 billion later, the market returned the verdict. This is not a spectrum from good to bad. It's a spectrum from system ready to system building. And the distance between those two positions is where most of the capital in this industry is currently being lost. So what does this mean for where the industry is heading? It means the next 3 to 5 years will not be defined by technological breakthroughs or policy announcements. They will be defined by system formation. In shipping, the question is which ports build the offtake infrastructure first and lock in the vessel operators. In chemicals, the question is which industrial clusters are geographically concentrated enough to support shared hydrogen supply. In aviation, the question is whether the regulatory mandates accelerate fast enough to make the first projects bankable before the development capital runs out. In every case, the question is not, can this industry use hydrogen? The answer to that question is almost always yes. The question is the system ready to support a bankable project today? And that question has a very short list of affirmative answers. And this is the part the industry is still catching up to. Hydrogen isn't a universal solution, it's a system-specific one. The industries that work are not the most visionary. They are not the most ambitious. They are not the ones with the most compelling stories about the future. They are the ones where the system was already built, where the demand was already real, where the buyer was already committed, where the contracts could be written before the concrete was poured. That is what separates the projects that get financed from the projects that get announced. And until you understand where those systems exist, and where they don't, you won't understand where hydrogen actually works. The framework we've used across this entire series, power, offtake, utilization, financing, was never just a checklist, it's a map. And what the market research shows is that right now, only a handful of industries sit at the intersection of all four variables being simultaneously solvable. Those are the industries worth building in. If you want to go deeper on how to apply this map to real project decisions, how to evaluate an industry, stress test an assumption, and structure something a bank will actually finance, that's exactly what we've built inside H2 Hub by Renee Energy. Links below. Hydrogen isn't failing, the system is filtering, and now you know exactly where the filter opens and where it doesn't.